The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3 o'clock. And if you miss an episode, you can always catch me on Spotify, or LI News Radio has a spot on their site, as well as Apple and the mainstreetcode.com. And we help hundreds of advisors across the United States, whether insurance advisors, attorneys, or accountants. They reach out to our advice on life insurance, disability, long-term care, and annuities. And because we're completely independent, we work with 30 different insurance companies. We believe in independence. Not one company is right for everybody. Not one product is right for everybody. So we really have a diverse background in insurance, and we operate as a wholesaler to agents around the country, as well as what I call helping you, our clients, with their insurance needs and issues. Today, well, it is February, it is Love Month, and what better way to show your love than buying a life insurance policy to protect your family for what they need. So I just wanted to say that happy Love Month, and it's either Love Month or Breakup Month for a lot of people. One of the things I can tell you is, flowers are great, but they die. Sorry, I get that every year from my wife. He goes, yeah, these are great, but, what happens then? A life insurance policy is for the rest of your life. There could be no better gift than to gift someone, or gift your children or your spouse or people you love, an insurance policy which may provide cash for their future and for their needs. And if properly structured, you could have living benefits as well. It could benefit yourself if you need it, if you become disabled or chronically ill or need long-term care. Many life insurance policies now cover all those events. And preparation is key, so prepare for the ones you love. Buy some life insurance, buy some protection for yourself and for your family. There could be no better gift. February is always a huge month for us. One of the things I really want to talk to you about today, that I've been working on all week long and all month long and all year long, honestly, is we've been doing more and more what we call life settlements. Now, you may be hearing ads on TV that say, if you have a term policy, if you're over 65, we've got money for you. Well, here's the problem. When you call those companies direct, and there's two of them, I'll give you their names, Coventry and Abacus. Both good companies. Are very big in this space where they buy life insurance policies. We work with both of them. But the issue is, if you call them directly and they give you an offer for a policy, they are going to give you a lowball offer. They're going to give you something that you might just say, hey, I'm not using the policy. Hey, I'll take a check. But really, it doesn't work that way. You're going to get the lowest offer that they can get away with, to be honest with you. So what we do is, we're a life settlement broker, as well as being specialists in life insurance area, is we actually take your policies to an auction and auction it off to those companies and other buyers out there that aren't what we call direct to the consumer. And by auctioning it, we can get you your best price. It's very important. Now, why would you ever consider life settlement? Because here's what happens. We are outliving our insurance policies. Many policies bought, 20 and 30 years ago, and I just acquired a book that has a bunch of these policies in it. They haven't been looked at in 20 and 30 years, so the policies are getting older and older. And if you haven't looked at it, maybe when you bought them in the 80s, when interest rates were really high, you would only expected to spend a certain amount of money, or you would only buy a policy that would last till you're maybe 90 or 95, and all of a sudden you're in your 80s, and you haven't looked at this, and several things have happened in the last 30 years. One of the biggest things that happened was interest rates were way high in the 80s and then dipped way low in the boom 90s when the market was going crazy and the tech world was going nuts. And people didn't realize that. Plus, over time, the cost of insurance inside these policies has been going up as you age. Even though you're paying the same amount of premium every year, that amount of premium is calculated when you buy the policy to last for the lifetime or to age 90 or 95, however it was structured at the time you buy it. So how do they structure that? So basically, you're overpaying in the earlier years, which is why permanent universal life or whole life is very expensive, it seems, compared to term life. But you're really overpaying in the beginning years, and then that cash that you put into your policy grows predicated on an interest rate on universal life or a dividend, which has some interest with whole life, and a dividend from a mutual insurance company that will pay you a dividend on top of it. And that cash growth plus the money that you're overfunding in the beginning allows that policy to pay for it for a much longer time, because they're using that money not only as growth but also to fund the insurance, which costs more and more every year internally in their contracts. So you're overfunding it in the beginning so that it will last a long time. So what happens is, if you don't fund it enough, and or if you're expecting an interest rate that's at 10%, let's say, and the interest rate drops to 4%, and all of a sudden you're 70 and 80 years old, the insurance company is going to say, hey, you owe us more money. Well, wait a minute, but I've been paying you this long, but hey, you owe us a lot more money because you're now 80, and the cost of insurance is eating up what you expected the amount of money to be in there, and now we're running into major difficulties whether we want to keep this policy or get rid of it. Now, a lot of people will say, you know what, I don't want to pay for it anymore, and they let it lapse. Well, then all that money that they've put into it is gone. So a lot of people are doing that. And other people are saying, hey, wait a second, I paid a lot into it. I expected this thing to last, and it's not lasting. But now they want more money. Maybe I can't afford it, or maybe I don't want to spend that kind of money on life insurance because now I'm 80 and, I want a fixed budget. So what do I do? Well, one of the options is to sell the policy to one of these buyers that buy these policies. Now, the way the whole buying process and everything works is, the older you are, the more valuable it is, because they're basically buying that death benefit from you. And if you're in poor health, it's even worth more to them because they'll get their money back that much quicker. So you want to establish the age of the person, what it's worth, and that's where the real value is. Calling somebody up on the phone is not going to give you the real value because they don't know your health. They don't know a lot of other things where they're going to make you a solid offer. This is why you reach out to Main Street Planning Group, and we tell you how the process works, and we walk you through it step by step if that's the direction you want to go. Or if you want to keep your policy, we'll go into quite details on what it costs to keep it and how to do it the right way so that policy doesn't lapse and you get no benefit. If you're buying life insurance, you're buying it for a reason. You want to protect your loved ones. But while we're no longer living and dying at 85, we're going to 90, 95, and 100. This is becoming more and more of an issue with these older policies. So please, if you have any questions whatsoever, reach out to us at themainstreetcode.com or call me at 631-647-4694. I'm Neil Himmelstein, and we're going to be right back after a quick commercial. Welcome back to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3. And before the break, we were talking about what a life settlement is and why you should call us and if you're considering selling your policy. There's a whole other thing going on. There's a lot of turbulence in the money, and the big money, the billionaires. Where are they putting their money right now? They're putting it into fixed income. They're putting into fixed assets. Berkshire Hathaway has got a lot of cash sitting on the sideline. They're worried. There's a lot of turbulence out there. Politically, geographically, interest rates are going to continue to go up. Everybody thought, 6 months ago they were going down. The Fed rate was going down. But truth be told, bond rates are up. When bond rates are up, fixed income goes up. Okay? Whether the Fed rate goes up, down, sideways, it's really predicated on bond rates. Bond rates are predicated by what the government has to borrow to keep funding things. With all the catastrophes, they're going to keep funding things. And if they slash and burn and get rid of all these federal agencies, there's effects and things that are going to happen. The market's going to go up and down like it always does. But you should really be considering fixed income and take advantage of really great fixed rates now. And we do two things in the fixed rate arena that don't require any risk whatsoever. And risk is a big deal. Let's face it. Risk worries me. Jumping into the market at this time worries me. Unless you really know what you're doing, it's very concerning. So how do I mitigate risk and take advantage of higher rates like the billionaires are doing? So there's two ways of doing it. One is people are scared of outliving their money. That's a known fact. Am I going to have enough money? Am I going to be able to retire and then still have an income? So we want to cover our fixed expenses first. The best way to do that is with a fixed annuity. Now, you're going to say, annuities, you talk about annuities. People don't realize Social Security is an annuity. Your pension is an annuity. That's what it is. An income stream is an annuity. You can buy your own pension. Even if you're 60, 70, 80 years old, you still have the flexibility of buying an income stream that you cannot outlive. My father was an investor from the 20s all the way through till he passed. I mean, he would be 117, right? He was born 1918. He'd be 100 and, 100 and, what would he be right now? I don't know. I can't do the math right now. I know he's like 107 right now. But my father always believed in the market. Big believer in the market. When he was older, he did buy an annuity. Not a big one, but he got some stock from MetLife or something, from a dividend purchase or something. And he says, what do I do with this money? And he bought an annuity, and he said, this is the best thing out of all my investments. And he used to watch Kramer and this, well into his 80s. He was watching this stuff all the way till he was 90 years old. He passed at 89. He's watching Kramer. He's watching the market. He did everything manually. He was the buy and hold guy. I mean, he did very well. He was a veterinarian. But he loved that paycheck every month. You know what? I don't have to think about this. This comes into my account. It covers my fixed expenses. And everything else is okay. My world's okay because my fixed expenses are covered. Everything else is investment. I'm a long-term investor. I know when to buy, when to sell. He held on to things for years. We'd have conversations. But the best thing he liked was that income coming in every month that he didn't have to think about. Came into his account, didn't look at it. That's called income for life. He had that till he passed. And he said, this was great. I said, when's this check? He kept calling. When's this check going to stop? It's not, Dad. It's going to keep going. I don't get it. This is how good can this be to have this income going for as long as I can? Now, if you're not ready to take an income and you're still in investment mode and you're still in growth mode, you should take advantage of the rates today. They're between 4.5% and 5% we can buy on a fixed annuity where there's no concern. You're going to make that money. There's no risk. Zero risk. It's incredible. No fees. No fees, no risk. What a great thing. The only risk is liquidity. A lot of times it's over a 5-year period. You could still take out typically 10 or 15% depending on your annuity. But basically that interest rate is guaranteed. It's compounded and it's not taxed until you use the money. That's a very important factor. I mean, you could say, okay, I'm going to buy a 4% CD or I'm going to buy a 5% CD. But I pay tax on that 5% CD. So if I put in $100,000 and there's no 5% CDs out there right now, there was briefly, and let's say I make 5% on it. So on the $105,000 and I'm on a 20% tax bracket, so I got to pay, let's say, $2,000 in tax on that. Or not, I'm sorry, 20% of 5,000 growth is 1,000. So I really only made 4,000. So now I reinvest it, the 104,000, but CDs I don't think compound, but when it's in an annuity, it compounds at that 105,000. And you're not paying tax on it. Now, when you use the money, you got to pay money on the growth, or you could spread out that growth over your lifetime in an immediate annuity where you can spread that growth out and spread that taxation out. And if you're older and you do this, very little tax because most of it gain is spread out over your lifetime. The IRS has codes that says, hey, I don't have to pay tax on all this income. I could just pay tax on a little bit of the income. Okay, because that's the only growth. The rest is part of my principal, but I'm buying that income stream. So there's two ways an annuity can work for you. It can accumulate and it can distribute. And it accumulates tax favorably and it distributes tax favorably. Now, if you're one of those lucky ones who still has a pension from a job and they're coming shorter, fewer and in between, and you have a pension because you worked for a company for a lot of years. And again, pensions are not as hard to come by. That's why 401ks became popular. It was more of a contribution thing and a match thing as opposed to I'm going to give you a pension for doing this job. If you're lucky enough to have a pension, they're going to offer you payout options when you retire. Whether I could take out a life income stream for myself, that's an annuity, or I'm going to give my spouse 50% after I pass, which is one of the automatic options with a lot of these annuities. You're going to be presented with these options. Call us when you get that letter and you're thinking of retiring because those options were based on a group annuity that may have been bought in a very low interest and rate environment, and maybe today's individual annuities will pay out better and will have more options for you when you retire if you still want that income. That we are actually beating the old pensions. That wasn't always the case, but when market interest rates started coming up, we saw a noticeable difference that our payout rates are better than the institutional 401k rates or pension rates that were established a long time ago when that company or institution put money away for you. So these are things you want to consider. Also understand when you do this annuity that pays 100% to you or 50% to your spouse when you die, or 100% to your spouse and it pays out when they both pass. You may not know this, but you're actually buying a life insurance policy. The difference between you taking the money all on your own or sharing it with your spouse at a much lower rate is really actuarially a life insurance policy. Very interesting thing. So there's ways of maximizing your pension and keeping more money for yourself and leaving more money behind if you give us a call. It's called pension maximization. It's a very interesting, intricate tool that we use with insurance and annuities. You're listening to the Main Street Code for Financial Success. Thank you for joining me. I look forward to hearing from you. You can give me a call, 631-647-4694, or visit me, themainstreetcode.com, or catch me out on YouTube, Apple, Spotify. Let me know your thoughts, and I appreciate all the lovely business and words and calls we get. Thank you very much. Have a blessed weekend.